Welcome, Maverick Traders. Welcome out to Drawing Risk Graphs. I'm Corey Halliday. Nice to be with you. And while drawing risk graphs doesn't sound like a real fun and sexy topic, it's actually a lot of fun. I think that going back to the basics and really understanding the fundamentals and doing these by hand is important. In fact, Rob and I have been doing these by hand for many decades before technology had kind of caught up. In fact, we have a mutual friend, Andy, who tells the story about in the late 90s. Rob actually taught him, pulled out a piece of paper and a pencil, and was teaching him how to draw these risk graphs. Well, fast forward a few years, and Thinkorswim and Interactive Brokers and all these trading platforms caught up to the concepts. Now they'll draw risk graphs for you as using the technology, and we're going to teach you that as well. But like I said before, I think it's important to kind of go back to the basics and get you drawing risk graphs by hand, really understanding them. So we're going to do that today. Let's have some fun. So when you think about a risk graph, what is it? Well, it tells you where your risk is, but it also tells you where your reward is. So in any risk graph, as you're drawing it, you're basically going to have your lines here, and on the left-hand side, you're going to have your profit and your loss areas. And through the middle of them, you're going to have your break-even zone, right? This is where you break even in the position. Down at the bottom, it will show the various stock prices. And these can be spread out in a number of different ways. These could be at every dollar, so it could be like 21, 22, 23, 24, 25, or they could be spread out every 5 points. You know, this could be, say, 70, 75, 80, 85, and so on. But your risk graph would basically tell a story. It will tell you about the risk, the reward, some maximum numbers. So any trade has a maximum risk, and sometimes that could come out to infinity. It could have no limitations. For example, shorting a stock is a max risk undefined, but most of the time there's an actual number here. You'd also come out to a max reward. What is the most that I could ever make in this position, and so forth. And you can draw out that risk graph, and actually it will tell you that story. So if we start very simply and say, well, what would trading stock look like, right? What would a risk graph look like? The risk graph will basically be dictated based on how much money you make, based on how many shares and at what price you buy, and so forth. So let's take a standard. Most people think like, okay, 100 shares, one round lot of a stock. If I buy 100 shares of a stock at $85 per share, then 85 becomes my break even. So at 85, there will be this dot here on the zero line. I'm not making anything, I'm not losing anything right there at 85, right? And then every bit, because I own 100 shares, every $1 that the stock goes up is $100 of profit. If it goes up $2, that's $200 of profit. $3, $300. $4, $400. At $5 increase on 100 shares, that's $500 of profit. So over here, it might demonstrate that. It might have on your risk graph, it would say, okay, right here you're up $100. Right here you're up $200. Right here you're up $300. And it would display these numbers in a way that you can quickly look at it and say, okay, at $90 per share, I'm up $500. So it would be marked up there, and then this would be a $400, this would be a $300, this would be a $200, this $100, and this risk graph would just go through like that. It would just be, and it would keep going, by the way. It would just keep being this line that accelerates in that fashion. And down here, of course, you'd lose $100 if the stock went down to 84. So right there we're down 100. Right here we're down $200, $300, $400, $500, right? And so this would display that the exact same way. It is a risk and reward graph in that it's showing you just in a graph how you're making and how you're losing money. And at $80, we're down $500, and of course that line would just keep going. The higher the stock goes, this would be a case where your max reward is unlimited, right? Infinity. You can make all that the stock goes up. If the stock goes from $85 per share to $170 per share, you've doubled your money. If it goes up again, it can go to 200, 300, 400, 500. It can go to infinity, right? There's no limitations on how much money you can make buying stock because theoretically it can go up infinite amounts. Now your risk would be limited. In this case, it would say $8,500 is the most you can lose. Why? Because you bought 100 shares of stock at 85, that's $8,500 invested. If the stock goes to zero, this line will just keep going, 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 and if it goes all the way down to zero, you will have lost your max amount, which is 8,500 bucks. So that risk graph on a long stock position, buying stock, will always move in that fashion. Okay, it will always move in that direction. The higher the stock goes, the more money you make. The lower the stock goes, the more money you lose. Now, for teaching people, I always like for you to be able to create your own risk graph. And so create a template of sorts. Look at this template, and it's pretty simplistic. And I could change it in any fashion. You know, if I wanted to come in here and edit, I could change this to 200, 400, 600, 800, 1000, 1200, 1400. You can make it any size you want. But just basically create some sort of template, even if it's on a piece of paper. Just draw it out. I mean, I would actually hand draw these at first to really teach yourself and to understand the ins and outs of it. So just get out a piece of paper, a pencil, and draw your risk graph. You'll have a break even. I like to make it a dotted line at zero, you know, at your break even, plus 100, plus 2, something like that. But you can spread those out however you want. Your gains will be up. Your losses will be down in that fashion across here, right? And then down at the bottom, you're going to have your stock prices. And here's where you can change it up each time. You know, we could call this $100 per share. We could call this, let's mix it up and call this 101. 102. And so what that does is if this is 101 and that's 102, well then this red line became 101.20, 101.40, 101.60, 101.80, 102, 102.20, 102.40, 102.60, 102.80, 103. Do you see what happened there? I can spread these out as as close or as far apart as I want. And I'm going to show you some software that'll do this as well for you. But we can spread this out however we want. And the stock prices go in this fashion, where the lower stock prices go to the left and the higher stock prices go to the right, right? And so let's do a short stock position. That's a pretty standard trade, right? I can buy a stock if I expect it to go up. Shorting a stock is betting on the stock going down. Now, here's the tricky part, and here's what making shorting stock risky is that your max risk is now infinite. There are no limitations on how bad this can get. Your max reward is limited to however far the stock goes down, right? From where you shorted it. So let's say that we short 100 shares at 100, okay? So in this case, our max gain, if we short 100 shares of stock at 100, we have shorted $10,000 worth of stock, 100 times 100. So because we have a $10,000 position size, that's literally our maximum reward. Is if this stock were able to go to zero, our short stock position, you wouldn't even have to close it. That means the company bankrupted. You never have to buy back the short stock position in that case, and you made all of that money. So imagine you shorted Enron stock, and then the fraud came out and stock plummeted and went to zero. You never even had to close your short stock position. You just made all that money. that it went down. Now that sounds really good and sounds really sexy, but pay attention to this risk. Here's why when you short a stock, you always have a stop loss. If you short a stock, you're required to buy it back, assuming it doesn't go bankrupt. You're borrowing the shares. So you have to buy them back at some point, and there's no limits on how high it could go, and eventually you're forced to buy in your short position. So if I shorted at 100 and it goes to $200 per share, I've lost 10 grand. It just doubled in my face, right? If it goes to 300, I've lost 20 grand. If it goes to $400 per share, I've lost 30 grand. Imagine those people that have been shorting Tesla forever, right? Just betting against Elon Musk or whatever, and they just keep shorting it and it keeps going up, 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 up. I mean, there are people out there certainly that have lost millions of dollars trying to bet against it. So you've got to be careful on the short side. I always think of shorting stock as a trade. It's not an investment thesis. It's really difficult to short and hold, to just sit there in a short stock position. And you're always at risk. There's things called short squeezes and all those sorts of things that can really cause you to pay the price. And even if the fundamentals don't support where the stock is, that doesn't guarantee the stock's going to go down. Think about the meme stocks. Think about how GameStop went from, $3 per share to like $700 per share within a couple of weeks, just because it went viral and so many people piled in that this was a story that went around the world, and everybody opened up their Robinhood accounts and started buying, and all of a sudden the stock went crazy. Detached from fundamentals, but nevertheless a wild situation. So, you got to be careful with shorting stock. That's the point. But if we look at our risk graph here, what's it going to look like? Well, if I short it at 100, then at 100 is my break even. So I'm going to put a dot there. I'm literally break even right there at 100, because if we think about it from the standpoint of this is where I shorted, if I buy it back right here, right now, I just broke even, right? I bought at 100, I sold. So it's equal. There's no gain, there's no loss. It's just like buying stock. As soon as you buy stock, you're in a break-even position. Think about it like real estate. If I go out and buy a real estate property, well, I'm at break even. I bought it for what its value was. Now, if I turned around and sold it, I could probably sell it for the same price I bought, So shorting, same thing. You're just break even the moment you get in. But your risk graph is going to look different, because now lower stock prices make you money. If the stock goes down to 99, this risk graph is going to look a little strange because these are spread out in this way, but that's okay. At 99, we're up $100. At 98, we're up $200. So I'm just going to kind of put some dots in here. At 97, we're up $300. At 96, we're up $400. And at 95, we're up $500. So our risk graph is going to be slanted just like this. It's going to be a line that goes this way, right? Now, if the stock goes up to 101, we're going to be down. I'll talk about why this is the case, but we're going to be down, and I'm going to put this in red. Down $100. Down $200 if the stock goes up to 102. Down $300 if the stock goes down to goes up, to 103. Down $400 if the stock goes up to 104. Down $500 if the stock goes up to 105, and so on. So our risk graph is the exact opposite of buying stock, of the long stock position. And it would go that way an infinite amount. And this one would go this way, not an infinite amount, because eventually it would hit zero, right? Eventually the stock would hit zero and we'd be capped out at our $10,000 gain. Why is this the case? When you short stock, you are selling. So you've sold here at 100. You've said, this is my sell price, but we've got to buy it back later. If it's going this way, we have to buy high, and we've already sold low. If you have to buy something at 103 that you've already sold at 100, you lose $3 times the 100 shares. But if I can buy it back cheaper at a later date, I make money. So I sold first, but I've got to buy it back second. If I can buy it back cheaper, I've made money. If I have to pay a higher price and buy it back more expensive, I've lost money. That's how shorting works. So you'll notice the long stock risk graph and short stock risk graph are literally the exact opposites, right? The long stock risk graph would be a line that just goes infinite that way. And guess what? The short stock risk graph would have risk infinite amounts, right, that way, and reward limited amounts this way. Going this way always can hit zero. So your profit in this case on the short stock position will eventually hit its max, or your risk if you buy stock will eventually hit zero, capping. So, they're opposites in that fashion. But you can see how the short stock risk graph always goes that way. If the stock is going up, you are losing money, right? This is a loss. If the stock is going down, you're making money. When you buy stock, it's the opposite. Stock going down, you're losing. Stock going up, you're winning. So your profit and your loss, your risk and reward, move in opposite directions in that fashion. Now, how do you sell something you don't own? That's why I said shorting is literally borrowing the shares, right? When you're short a stock, you have borrowed the shares to sell in the market. And why would somebody lend you those shares? Because you're paying them a little interest. So there's always some added expenses with shorting stock. If I go out and just spend my money and buy stock, okay, great. I don't pay anybody anything. It's my money and I bought the stock. When you're shorting, you have to pay this person a little bit of interest over time because you borrowed their shares. And to that person, they're saying, well, I was just going to sit there and hold the stock anyway, so what do I care? I'll lend them out to this person who can short them. They'll have to buy them back and so on, and I'll pick up a little interest. If you were just going to sit there buying and holding your stock anyway, lending them out as a short can make you just a little bit of extra profit. So that's how shorting works, is you're borrowing the shares. Some people worry like, if you do a lending program and all these sorts of things, are you ever at risk that something like defaults and falls apart? Well, you're actually protected. There's insurance and things in effect where basically if that person on the other side couldn't make good on their promises, that falls to the broker. The broker is responsible to make sure that their members, their clients, can make good on all their promises. The same thing is true in the options market. You don't really run into defaults and things like that where you don't get your payoff. In other words, it falls to the broker and they pay for it. It's kind of like, FDIC insurance and things like that, where there's insurance in place to make sure that these promises are kept. So that's how shorting stock versus buying a stock works. Now, let's look at platforms. So those are, some basic risk graphs. There are platforms that you can go to build these risk graphs that are pretty incredible. So if we come over and we say we were going to buy some stock, and here's Microsoft, and it's trading at a really high price, and let's say that we were going to buy 100 shares. Let's just create a hypothetical, okay? I want to go out and buy 100 shares of Microsoft, and let's make it an easy number let's go to 292 even. In fact, let's even go to 290 per share. Now, this would require the stock to come down in order for this price to get filled. But let's say we're going to attempt to buy 100 shares at 290 per share. Well, first of all, that's expensive, right? That's $29,000 worth of stock. But I wanted to pull up an expensive example. Now, before I transmit this or anything, if I just right click, I can go to the Analyze tab. And the Analyze tab, this is Thinkorswim through Ameritrade. The Analyze tab will show the risk graph. See this purple line? Look at that. It's got gains over here on the left. It's got losses over here on the left going down. It's got the stock price down here at the bottom. It's got 290, which is what we're trying to pay right at your break even. See that mark at break even at 290. And then everything that goes up from 290, we're making money. And everything that goes down, we're losing money. Now watch this. I can drag it out if I wanted to, and it will change the metrics. See how it's changing the metrics over here? We could even get this to say 100, 200. Watch this. I'll just keep spreading it out until it finally goes to a different metric here. Let's see if I can get it to work. There it goes. Okay, so see that? Now we're at plus 100, minus 100. And see, here's 290 per share. If we bought 100 shares at 291, look at where you're at. Plus 100 bucks. You see that? That purple line went up. So as the stock goes from 290 to 291, bingo, up 100. To 292, up 200. To 293, up 300. And all I did was just sit here and hold down my left mouse key and drag it out, and just move it around, okay? If the stock goes down 290 to 289, whoop, there it is, minus 100. 288, minus 200. 287, minus 300, and so on. You can see that risk graph in action, right? Now watch this. Let's drag it back the other way. And let's go really crazy with this and get them spread. I want it to the point where I can see 0. Now watch. We bought the stock at 290 per share. If it goes to 0, I mean, here's 290, goes down to 200 per share, 100. I don't know how Microsoft goes bankrupt, but theoretically, if it did over time, you would see your loss down here. It's basically the $29,000 that you paid. Right down here would eventually hit 0. And I don't know if we can even see it very well, but there's your $29,000 loss basically as the stock hits bankruptcy, right? But if you bought it at 290 and theoretically it went to 400, 500, 600, 700, you can see the infinite amounts of reward. This line never stops. It never stops. So look, I mean, you put out a crazy number. Microsoft goes from $290 per share to $2,000 per share, and what happened? Your $29,000 became $170,000, right? Now it's worth a house, or whatnot. And so you can kind of see these numbers in action, right? That's what a risk graph does, is it just shows you. And so as you get used to this, you can just sit here and drag it out and so forth and get used to this. You can manipulate these charts however you want. I got to go way back here, sorry. What I should do is do this and get it spread in and then jump first before I spread it back out. Because we need to get all the way back here to 290 per share where it's at. And then it makes a little more sense, right? I buy it at 290 and you can see your gains and losses. And as you drag this out or drag it in, it basically changes these metrics, because the wider you make these prices down here, the bigger the values are. The more you zoom in or zoom out, the more it changes that, right? So if I want to zoom in, it will knock these values down, because now I'm zooming in to the smaller price changes. And as I zoom in to the smaller price changes here, it reduces the values here, because smaller price moves equal smaller value changes within your trade. Now, if I were to switch this up, watch how easy this is. If I just simply switch this from buying the stock to shorting the stock, that's all it is instead of buying, I'm selling it short. If I don't have Microsoft in my account and I simply sell it short, right? I short the stock. Watch what happens. Right click, analyze. Now I need to nuke this one. We can't have a long and a short. So I delete the buy. Now I just show the sell short position, 100 shares at 290. Look at how the line flip-flopped. Do you see how now as the stock price goes down, the profit goes up? But as the stock price goes up, the losses start to mount, right? And the same thing happens, but in reverse. So now all of a sudden, if we look at it, let's zoom in first. Okay, let's zoom in here first and get that to flip to 100, 200, and so on. There it goes. So see that? Now 290 is where the stock is at when I shorted it. If it goes to 289, that's $100 of profit. If it goes down further, that's more profit. Now I'm up 200 bucks. Now I'm up 300 bucks, 400 bucks, 500 bucks, and so on. If the stock goes up and you're short, well, that's where you lose. If it goes up $1 per share on 100 shares, you lost 100 bucks. You're down 200 bucks, 300 bucks. And watch what happens. You guessed it. This is going to go infinite. There's no limitations. This is going to have a max, right? It's going to have a max because, well, the stock can only hit 0. Can't go any further than that. So watch this. Let's do it out to there. I think that'll show it. So if we shorted the stock and it went to 0, if the stock basically plummeted, maybe I went a little too far here. Let me make sure I've got this scaled in a way that's reasonable. I probably got a little too aggressive here with it. There we go. So if we shorted the stock at 290 and it went to 0, we're going to be up about $29,000, right? We collected $29,000 when we shorted the stock. If you watch, if I go into confirm and send, watch what happens. It's going to tell me you're getting a credit of $29,000 because you're selling 100 shares at 290. But this $29,000 that you're collecting, you're going to have to spend a lot of that probably to buy it back, right? It's probably not going to 0, but theoretically, if you shorted the stock, collected the 29,000 and it went to 0, you'd never have to buy it back. The stock goes away, it ceases to exist, and you made your 29,000 bucks. That's what this shows. Stock price going to 0 is $29,000 of profit. But here's the problem with shorting. Stock price might go infinite amounts this way. And right here, you're down 29,000 because it doubled in price. Right here, you're down, more like 60,000. It tripled in price, and on it goes. In a short stock position, you have infinite risks over here. If we think about risk graphs, again, let's do a basic example risk graph. Let's buy a call. And we'll also maybe show buying a put. So when you buy a call, this one, your reward is infinite. Risk, we'll leave it in red, is whatever you paid for that call option. So let's say we paid 500 bucks. Okay, $500 is the most you can lose. That's what you spent on that call option. Now, when you buy a call option, it's really kind of interesting because there's a strike price involved. There's details, right? If you buy a call, it has an expiration. So let's say that's September. And let's say there's a strike price. So let's say that the strike price is $80. 80 strike call in September. Okay. So now down here on the risk graph, we might show 80. Let's go. And I actually want to move that. I'm going to move 80 down here, and you'll see why in a second. This will be 79. This will be 78. This will be 81, 82 per share, 83 per share, 84, 85, and so forth. Okay. Now this will make sense in a minute, but here's why. When you buy a call option, you will lose all that you spent for that call option if the stock at expiration is at the strike price or lower. So at $80, we're going to lose 500 bucks. And if it's any lower than that, at 79, 78, 77, and so on, we're still going to lose 500 bucks. We're going to lose $500 if the stock is at the strike price or lower. No matter how low it goes, doesn't matter, the company could go bankrupt. We can only lose what we spent, which was $500 for that call. We must have paid $5 in premium, right, to buy that call option. So that's our loss at the strike price or lower. And the reason that's a loss is you have the right to buy the stock at 80. That's what this call option gives you. But if the stock's at 79, you're not going to pay 80. If the stock's at 78, you're not going to pay 80. If the stock is at the strike price or lower, there's no added value in this, which means we have to get to 85 just to break even. Just to be at break even, this stock has to climb up to $85 per share. So if you look at your risk graph, it's going to go like this. And I'm not drawing it very perfectly, but it should just go in a straight diagonal line that way. Okay, mine has a little curvature, but just ignore that and imagine that this was just kind of perfect. Okay, just as perfect as can be, diagonally this way. Why? Because if the stock's at $81 per share, your call would have some value. The problem is it would only have $1 of value. It'd only have $100 of value. Why? Because I get to buy the stock at 80 and it's worth 81. That's $100 of value. The problem is I paid 500 bucks for this call option. So I'm still net, I'm still down 400. If the stock's at 82 and I get to buy it at 80, well, I have $200 of value, but I paid 500. Well, I'm still down 300, still down 200, still down 100. Now I'm back to break even. I get to buy the stock at 80 and it's worth 85. That's $500 of value. Well, I paid $500 for this position to buy this call option early on. So I need the stock to be above the break even. At 86, now I'm profitable 100 bucks. At 87, I'm profitable 200. At 88, I'm profitable 300, and so on. And again, reward is infinite, meaning the stock could go up infinite amounts, right? At $120 per share, 140. The higher and higher it goes, the more money I make owning that call option. So buying a call is very bullish. Buying a call does give you infinite reward potential, but this is the drag of time decay and volatility decay. You're paying for that possibility of big things, and you're paying someone time value, and that time value erosion means that your break even's even higher, so you have to overcome all that time value decay just to get to break even and then some. So you really, really need a big move up to be successful in buying call options, right? That's what buying a call risk graph will look like. A long call will always have a risk graph that's flat to the left, would go up infinite amounts to the right, just like that. So if that's what a long call risk graph looks like, think about in your mind just for a second what buying a put would look like. Can you envision it? If this is what buying a call looks like, what's your best guess for what buying a put option looks like? Just think about how it would look. Well, did you envision this? Buying a put would give you a risk graph that looks like that. The exact kind of opposite, mirror image, right? This is what buying a put, or what we call a long put, would look like. And it literally would just be the opposite components. It would have, risk that would just flatline that way. It would have reward that eventually would hit the break even and then just keep going and going in that fashion. That's what buying a put risk graph will always look like. So buying a call, buying a put, they're kind of that mirror image because they're literally kind of the opposite trades that way. And that, well, they're both the same in that you buy premium. They're both the same in that you have risk of time decay and so on. But where they're different is buying a call is the right, it's the ability to be able to buy the stock at the strike price. Whereas if you buy a put, it doesn't give you the right to buy the stock. What does it give you? It gives you the right to sell the stock. And so the only difference between buying a call and buying a put is one little word, is that a call gives you the right to buy and a put gives you the right to sell, but that flip-flops things, doesn't it? If I have the right to sell the stock, no matter where it goes, which is what buying a put does for me. If I have the ability to sell the stock at $100 per share, let's say this is 101 and this is 102 and 103 and so on. Now I'm paying premium for that right. Whoops, 98, 97 and so on. Okay, I'm paying some money to buy that put option for the ability to sell it for 100 no matter what. What's going to cause my put to go up in value? The stock price going down. When you think about it, this gives you the right to, you want to be able to buy low. So a stock price going above a call strike creates the value, right? Because you get to still buy it low at the strike price and it's accelerating to the upside. You get to brag about that. You get to say, hey, I have the right to be able to buy the stock. This call option allows me to pay, $100 for the stock, and it's all the way up at 120, 140, whatever. With puts, it's the opposite. Because you have the right to sell at the high price, you want the stock to plummet. And as the stock plummets, your put goes up. Because if the stock goes to 90 and I have the ability to sell for 100, that's a great value. If it goes to 80, that's even better. Stock's down to 80 and I still get to sell it at 100. Stock goes to 70, it's even more valuable. The further the stock goes down, the ability you have to sell high is what creates that value, right? So let's look at this in our platform, okay? Let's nuke Microsoft and go to a new stock. Let's pick a lower price stock. Let's just say we were going to buy an option on, I don't know, Roblox or something or whatever. Okay, so Roblox is trading at about $50 per share. And let's just come in here and hypothetically we were going to buy in October, whatever, 50 strike call. Okay, let's just build one. Look at what this risk graph will look like. I'm going to right click and then hit analyze. Bingo, there's a risk graph. Focus on this kind of green, bluish color, whatever that is. I don't know, aqua. Stock at 50, we lose all the $610 we paid, right? Remember, we're buying the 50 strike call, so at the strike price or lower, we lose all of that at expiration. We lose $610, this flat line. But if the stock price goes up, eventually we hit our break even, which is 56.10. Strike price plus the premium paid gets us back to break even. And then we need to be above that to make money. But look at the infinite possibilities, right? The higher the stock goes, the more money we make. That's the appeal of buying a call, is that, infinite possibilities. If there's a crazy move, somebody says, when would you ever want to buy options? Well, you want to be a buyer of options when something crazy is about to happen, right? So buying a call, huge upside, limited downside. But the problem is there's a very real possibility that it's just going to finish in here and that you're going to have a drag of value. So yeah, there's a huge upside possibility, but there's a lot of ways to lose right in here. Now, if we were to flip this and instead of buying a call, we were going to buy a put. So let's delete. Let's come over to the puts. And instead of buying the call, now see how I'm buying the 50 strike put. It's going to cost me 645 bucks. I'm going to right click and analyze. And now the risk graph flip-flopped. Now the stock at 50 or above, I lose, see over here, I lose 645, $645 max loss no matter how high the stock goes. But if the stock can go down, my ability to sell at 50, which is what a put gives me, I get to sell at 50. If it goes down, 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 I eventually break even and then go into profit by expiration. So I need it to be below the break even. I need it to be down here at 40 or in the 30s or in the 20s. And, you know, the lower the stock can go, the more profit I make. That's the appeal of buying a put. When would you want to buy a put? Again, right before something crazy, specifically to the downside, is going to happen. So from a timing standpoint, I mean, I don't trade a lot of long call, long puts. I'd much rather do spread trades. The more complex strategies actually have higher probabilities of success, meaning, you know, you're much more likely to do well in a spread than just buying a single option. Single options are easier to understand for people, and so anybody that's dabbled in options probably does a lot of buying of calls and puts, and these are the lowest probability of success trades. They're really the hard way to try to make money, right? Spread trading and doing things like that, well, you can take advantage of time decay and volatility and these other components, whereas if you just buy an option, you just need a big move in the right direction. In this case, if you buy a put, you need a big move to the downside. All right, well, we'll leave it there, but thanks everyone for joining us. I hope you enjoyed this class on drawing risk graphs. It's kind of a two-part series. We're going to do another advanced risk graphs class, so check that one out as well. Keep having fun with the process. On behalf of Maverick Trading, I'm Corey Halliday. We'll see you next time. Goodbye, everyone.